There is a great deal of discussion about when China's property market will finally bottom. Will house prices stop falling this year, next year? Has the worst already passed? But perhaps we are asking the wrong question. So today I want to look at China's property bust through the lens of Austrian economics and ask different questions. Where are the bargains? Because China's property crash may ultimately prove to be one of the largest transfer of assets in modern history. The winners are unlikely to be those who buy whatever has fallen the furthest. They will be those who identify productive assets, understand Beijing's objectives, and have the patience to wait while the excesses of the boom are slowly worked out of the system. That was the lesson of Japan, and it may yet become the lesson of China. So we can learn a great deal from what happened after Japan's property bubble burst more than 30 years ago. There is one important difference. An Austrian economist looking at Japan could largely focus on markets. In China, the government itself is one of the most important actors in determining who wins and who loses. Austrian economists argue that economic booms often begin when credit becomes too cheap and too plentiful. Investors start making decisions that would never make sense under normal market conditions. Austrians call this malinvestment. Too much capital flows into projects that ultimately cannot generate adequate returns. So if we look at China over the last 20 years, this description seems remarkably accurate. Developers borrowed heavily, local governments become dependent on land sales, households treated apartments as savings accounts, banks expanded credit, and entire districts were built ahead of demand. Property became the dominant store of wealth for hundreds of millions of Chinese families. The result has been one of the largest property booms in human history. Austrian economists would say the question is not whether prices have fallen, the question is whether the investments ever made economic sense in the first place. This is where many investors can go wrong. If an apartment which was once sold for 3 million yuan now sells for 1 million, people immediately assume it must be a bargain. But Austrian economists would ask a different question. What is its real value? Because you have to decide who wants to live there and what income would it generate. So what economic purpose does it actually serve? So a half-empty apartment block in a shrinking city may not be attractive at any price. A shopping centre with no customers is not a bargain simply because it's become cheap. Austrians distinguish between assets that are productive and assets that merely appeared valuable during the bubble. This distinction is critical. When Japan's property bubble burst in the early 1990s, many investors rushed in to buy cheap real estate. Some made money, many did not. The most successful investors often took a different approach. They bought distressed debt. They bought non-performing loans. They bought assets from forced sellers. And they focused on assets that generated cash flow. Goldman Sachs purchased portfolios of bad loans from Japanese banks. Lone Star bought distressed real estate and loan portfolios. Wilbur Ross built a career buying distressed financial assets after credit collapses. These investors were not simply buying apartments because they'd become cheap. They were buying claims secured against assets which had real income. One of the most famous examples was the American private equity firm Lone Star. During the late 1990s and early 2000s, Japanese banks were burdened with huge portfolios of bad property loans. Many of these loans had been made during the bubble years. When property prices collapsed, the banks found themselves sitting on enormous losses. The banks wanted these losses off their balance sheets. Lone Star stepped in and bought portfolios of non-performing loans at steep discounts. So suppose a bank had lent the equivalent of £100 million against a portfolio of commercial properties. The bank now might be selling these loans for £30 million simply because it had to clean up its balance sheet. If the underlying assets ultimately recovered even modestly, the investor could make enormous returns. And that is exactly what happened in a number of cases. Another famous example involved the Long-Term Credit Bank of Japan. The bank had effectively collapsed after the property bubble burst. A consortium led by Ripplewood Holdings purchased the institution after it was nationalized. The bank was restructured and later relisted as Shinsei Bank. The investors reportedly made several times their original investment. Again, let's look at what they bought. They didn't buy apartments, they bought distressed financial assets and claims on productive assets. Perhaps the most important lesson is that many successful investors bought assets that continue generating income even during the crisis. So imagine two investors in Japan in the year 2000. Investor A buys a cheap apartment in a declining regional city because prices have fallen by 70%. Investor B buys a portfolio of lawns secured on prime Tokyo hotels and office buildings. 20 years later, which investor is likely to have done well? The answer is obvious. It's investor B, who owns claims on assets that continue generating cash flow. The hotels are still hosting guests, the office buildings are still collecting rent, but the apartment in the declining city may simply continue declining. This is one of the most important lessons from every property bust. The biggest winners do not necessarily buy the assets that have fallen the most. They buy the assets that remain economically useful after the bubble has burst. So the question is China repeating the Japanese pattern? This is why I believe many investors are looking in the wrong place. The headlines focused on Evergrande. They focus on apartment prices. They focused on ghost cities. But the real opportunity may lie elsewhere. If China follows the Japanese pattern, the most attractive opportunities may not be residential property at all. They may be hotels in Shanghai and Beijing, shopping centers in prime locations, warehouses and logistics facilities, distressed loans secured on productive commercial assets, and REITs holding these assets. So imagine a hotel in Shanghai. It might cost 1 billion yuan to build today, but a distressed owner may be willing to sell it for 500 million yuan. The hotel is still operating. It still generates cash flow. Tourists are still coming. Business travelers still need rooms. The asset remains economically useful. This is exactly the type of situation that attracted successful investors in Japan. And it may be exactly the type of opportunity that emerges in China over the next decade. So if there's one sector I would watch closely, it is hotels. Hotels are fundamentally different from residential property. A hotel can be valued based on occupancy rates, room rates, and profits. You don't need to assume that property prices will rise forever. So China is expanding visa-free travel. Domestic tourism has recovered strongly from the lockdown period. Business travel is gradually improving. Meanwhile, many owners remain under financial pressure because of the broader property downturn. This creates exactly the kind of opportunity that distressed investors seek. In some cases, hotel transaction prices appear to have fallen below replacement cost. In other words, it may cost more to build a similar hotel than it costs to buy an existing one. Historically, that is often a sign that a cycle is approaching its trough. Before going further, let's briefly explain what a REIT is. REIT stands for Real Estate Investment Trust. Think of it as a stock market fund that owns property. Instead of buying an entire hotel, shopping center, or office building by yourself, you buy shares in a company that owns these assets. Why does this matter? It's because one of the biggest problems in a property crash is the lack of buyers. Suppose a hotel is worth £100 million. Only a small number of investors can buy the whole building. But if the hotel is placed inside a REIT, thousands of investors can buy small shares. That creates a much larger pool of potential buyers, and more buyers generally support higher valuations. That is why investors are paying close attention to China's efforts to expand its REIT market. If Beijing eventually allows more hotels, shopping centers, and commercial properties to enter REIT structures, a great deal of new capital could enter the market. One of the most interesting transactions involves Wanda. Wanda became one of China's largest owners of commercial property. As financial pressures increased, it began selling assets. A consortium led by PAG has acquired dozens of Wanda shopping centers. Think about what is being purchased. These are not empty apartment blocks, these are operating businesses. They have tenants, they generate rent, they had cash flow, and the seller needed money. This is exactly the type of situation that has attracted distressed investors throughout history. The asset may be healthy, the owner may be distressed, but these are two very different things. But there is a problem with pure Austrian thinking. So at this point, we have to make an important adjustment. China is not Japan, and it is certainly not America. A purely Austrian analyst can miss something very important. The Chinese state itself can dramatically influence asset values. The government controls the banking system, land supply, local government finances, capital flows, state-owned developers, and much of the restructuring process. An investor in China is therefore not simply analyzing markets, he is analyzing policy. The key question becomes, what does Beijing want to happen? Many Westerners assume Beijing wants another housing boom. I don't think that is right. The leadership has repeatedly said housing is for living in, not for speculation. This is one of the most important clues investors can receive. Beijing appears to want stable housing markets, fewer speculative purchases, more household consumption, more advanced manufacturing, more investment in technology. If this interpretation is correct, then investors looking for a return to the great housing boom of 2005 to 2020 may be disappointed. The state may support stability. It doesn't support another bubble. This leads us to one of the most important parts of the story. What government policies should investors look out for? First, I think the expansion of REITs. This could be extremely important. Hotels, shopping centers, and office buildings all need buyers. Beijing continues expanding the REIT market. It creates a new pool of capital. Pension funds, insurance companies, retail investors all gain a way to invest in income-producing property. That can support valuations significantly. Secondly, support for tourism is critical. For hotel investors, look out for visa-free travel at international events, tourism promotion, easier payment systems for foreigners. Every additional tourist supports hotel revenues, and higher revenues support asset values. And thirdly, look out for local government asset sales. This may be one of the largest opportunities of the next decade. Local governments are under enormous financial pressure. Land sale revenues have collapsed. Debt burdens are growing. At some point, Beijing may encourage local authorities to sell assets. Hotels, shopping centers, office building, infrastructure, linked assets. If that happens, distressed investors could find extraordinary opportunities. Fourth, bank recognition of losses. Markets cannot heal until losses are recognized. If the banks are allowed or required to sell bad loans and dispose of collateral, then genuine price discovery can begin. Genuine bargains become visible. Look out for policies that encourage consumption. Look out for policies that boost consumption. Hotels and retail properties ultimately depend on consumers. If Beijing improves pensions, healthcare and social safety nets, households may feel less need to save and are more willing to spend. That would directly benefit hotels, restaurants and shopping centres. So how can an American investor participate? At this point, many viewers may be thinking, well, this all sounds interesting, but I can't exactly fly to Shanghai and buy a hotel. That's true. The average investor is unlikely to buy distressed commercial property directly. Instead, the opportunity may arrive through financial markets, just as it did in Japan. Investors can gain exposure through REITs, listed property companies, distressed debt funds, private equity firms specializing in restructurings, commercial property portfolios. The irony is that the best way to profit from a property bust may not be buying distressed assets at all. It may be buying the companies and funds that specialize in acquiring distressed assets. That is exactly how many investors gained exposure to Japan's recovery, and it may be how investors eventually gain exposure to China's recovery. Many investors trying to predict the exact bottom of China's property market should stop doing this. History suggests that the investors who profited most from Japan's collapse did not make fortunes because they predicted the price bottom. They succeeded because they bought productive assets from distressed sellers at extraordinary discounts. The real question is, what assets remain economically useful, generating cash flow, and can now be purchased at prices that assume permanent decline? And perhaps the most important question of all is, which parts of the property market does Beijing actually want to survive and prosper? Because in China, unlike anywhere else in the world, understanding government policy may be just as important as understanding economics. Investors who combine both may discover that the greatest bargains of China's property bust are not where most people are looking. The biggest mistake investors can make after a bust is assuming that everything cheap is a bargain. The profits are made by identifying the assets which remain useful long after the bubble is gone. Thank you for listening. If you enjoyed this analysis, please like and subscribe, and tell me what you think in the comments below.